Welcome back to Switzer. Continuing my crusade to find smaller companies that have market upside, but also which have a great history of paying dividends, I asked Roger Montgomery if he could find some that also conform to his investment principle of buying stocks where the market price is less than its intrinsic value. Welcome, Roger.
G'day, Peter.
Now, Simon did his homework. Did you do your homework?
Mate, we do it every day.
Right, okay.
We're doing the homework every day.
But I knew it was a tougher one for you because you've got this principle that intrinsic value versus market price.
Yes.
So, but also, you got the other thing is that you're not a great lover of dividend-paying companies. Is that a fair call?
I think people misunderstand that. We love getting the dividends from companies that should pay them. But we don't want to receive dividends from companies that should keep the money and compound it at 40%, because I can't get 40%. So if a company is able to generate a very high rate of return on its equity, I'd rather not receive the dividend from that company. I'd rather they keep the money. But there are a lot of companies that generate very low rates of return on equity, and we still might buy them at very, very cheap prices. We want those ones to pay all their profits as a dividend. Because if they're generating 5, 6, 8% return on equity, we don't want to give them the money to reinvest at that rate. We'd rather keep it, and maybe we can get 20 or 30% somewhere else. Or certainly put it into a business that is generating 30, 40% return on equity.
Okay.
So I hope that clarifies.
Yeah,
we love dividends when the right companies are paying them.
Yeah. Okay, that's a good point. So, were you able to find a company that conformed to your view, market price was less than intrinsic value, but also paid reasonable dividends?
Well, I don't know about the reasonable dividend.
But paid dividends.
Pays dividends.
Okay.
The only one out of... And what I did is I looked at all the sectors, and the one that shone was JB Hi-Fi.
Okay.
That was the only one. Yeah. Now, having said...
So still you must think...
We bought that at half its current price.
Yeah.
You know, and we still own it.
But you told people on the program.
Yeah. And so just don't think I'm buying now. Now, I think there's very real risk associated with buying stocks with your ears pinned back today. But having said that, I do believe there's great value in some of these floats. And there's a lot of them. You know, there's 23 between now and Christmas. It's a lot of floats.
So that's where you think that the intrinsic value of some of those companies is really nice?
So, for example, and you might be asking why, because typically what happens is in a float, you've got a very knowledgeable seller and a less knowledgeable buyer, and so typically the vendor does better than the buyer in these situations. Okay. But in some situations, such as Veda, for example, the credit reporting company.
And by the way, I always say it's Veda, but I think they say it's Veda.
Veda. Look.
Anyway, so Veda Advantage is
people get my name wrong all the time.
You're kidding.
So
Veda, when's that going to be listing? In December?
Second week of December.
Okay.
So interesting thing about this business, its owner is a private equity owner, Pacific Equity Partners, PEP. Now, what's interesting about this is you would expect them to absolutely maximise or extract the maximum price that they can. I'm guessing that they haven't in this particular situation, because the price is $1.25 a share. We reckon it's worth about $1.77. And we ask ourselves, well, why is it that we're getting this value? You know, typically you wouldn't expect it. Well, if you look at the history, the recent floats of PEP include Collins Foods, which wasn't a particularly auspicious one for them. It didn't go very well for buyers of that particular float. So I believe, and I'm just guessing, that they've been rather generous with this particular float because they know they've got a pipeline of other floats and they want to earn back their reputation for leaving some value on the table for other investors. And so it strikes me that this one looks pretty good. Another one that looks pretty good is Life Healthcare. Life Healthcare is involved in the wholesale supply of the screws and braces that are put into the spines of people who are suffering from ankylosing spondylitis and scoliosis to straighten their spine. They also produce an artificial disc for somebody who's had a ruptured disc or a herniated disc that needs to be removed or whatever. And the third one that we're looking at the moment, is an insurance business, travel insurance primarily, called Covermore. And that one appears to be very good value
Is it a travel insurance business?
Well, that's its primary offering.
Right.
But but these three businesses combined are 3 of the 23 that we believe are extraordinarily high quality businesses with very good management, and we believe they're coming on at a price. Now, if you look at the demand for some of these things, and you look at, I know one of the floats recently, I think there was a public offer of about $30 million, and I'm just giving you an anecdote here, I won't name the name, but $30 million. The bids for that $30 million exceeded $1 billion. So there's enormous demand for these things. Now,
I think I know what you're talking about.
The fund managers know that this is the only game in town because there isn't a lot of other value. Unless you want to play the momentum game or the sectoral shift game, this sector has done really well now. That one's lagging. I think that one's going to catch up. We don't like playing that game. That's a little bit like racing a Ferrari against a Combi and saying, well, the Ferrari's won heaps of times now. The Combi's going to catch up and the Combi's going to win a race. The Combi will never win. So we don't play that game. We're interested in what I've just described. And that seems to be why they're so popular, because there's not a lot of value elsewhere.
Okay. Explain to the viewers how you're able to determine the value of these companies.
Yes.
Is it purely based on the numbers that they've presented in the prospectus?
Well, what's interesting about all of these businesses is that they've been in business prior to them listing. So a lot of people believe, oh, they're a new company. Well, yes, they're new to the market, but they've been around for a long time. And if you look at the prospectus and you dig deep enough, you will find a track record. And where there's no track record, we may not be interested in buying it. But where there is a track record, we can establish an estimate for its value. And if that value is rising, we believe the prospects are good for this business. It's not always true, Peter, that private equity comes along and rips everyone off and then you're left with, holding the baby. I can remember the Reject Shop, which listed in 2004. The vendors, many of them got out of that business at $2 a share. It's subsequently traded at 16. It's been a great business, and its return on equity has increased, its store footprint has increased, its debt has gone up slightly, but not nearly as much as its equity.
Here's a question a lot of people ask me about fund managers like you. When the market runs ahead, and you've been saying there's not much value left in the market, so you need, in a sense, earnings to either surprise and even shock you and do really, really well, because then that means that the market price, once again, could be lower than its intrinsic value. So, but if
that presumes we're not already invested. Now we've achieved, and I'm not saying this to boast, but we've achieved in the Montgomery fund a 42% return since August last year, with an average.
But your last few months wouldn't have been as good because you've been reticent, and you told me
we're raising cash. We're raising cash at the moment. Now, historically, whenever we've done that, whenever our models say it's time to raise cash, the market hasn't run on. So this could be one of those rare situations where the market does run on and we're left with cash. But the returns that we've achieved to date have been done with an average of about 30% cash.
But what are you going to do, Roger, if because I wrote a piece today on my website and said, well, maybe this is one of those rare times where you can say things are different this time.
Well, I believe if you read the transcripts from the Federal Reserve, from Janet Yellen and also her potential vice chair, what they are talking about is a regime shift in the United States, where they stop the Federal Reserve actually focusing on inflation and they start focusing on GDP.
And jobs.
And they keep the foot on the accelerator for longer. So rather than a tapering, we may actually see it stronger for longer. We may in fact see a bubble. Now, I haven't got the exact quote here from Janet Yellen's talk, but there was talk about an irrational fear by her predecessors of a bubble, an irrational fear of a bubble. So what she was saying is, there is a present and imminent fear pervading the Federal Reserve of a bubble, but she thinks what's more important is not worrying about the bubble, but worrying about economic growth. And so, there's very clear indications from the future potential chair and vice chair of the Federal Reserve that they're going to actually keep pumping money into the economy until we see very strong growth. You haven't seen a bubble yet. So all this talk in the market, you hear some of the commentators say property market's in a bubble, stock market's in a bubble. Not true. We're not even close to bubble conditions. I think we're a little bit higher than intrinsic value in aggregate. The market is a little bit expensive, but it isn't so expensive that we're selling out completely and getting into cash because we fear an impending correction.
But if that happens, Roger, if she actually puts the foot on the accelerator more,
the stocks we own will go up a lot. We'll be thrilled.
Okay, all right. So any other observation that you...
Yeah, look...
one last one.
I think the Australian interest rate situation, I've read some economists saying interest rates are going to go up next year.
Yeah.
We know that we need the Australian dollar lower for our competitiveness.
Yeah.
So I think as US rates climb, we'll see Australian interest rates stay lower for longer. So you don't need to fear rising interest rates imminently either.
Yeah.
So the conditions are prime for an extension of this rally. I think we're mid-cycle. I think we've got a bit to go.
All right, mate. Thanks for joining us.
It's a pleasure, Peter.
Okay, if you want to read my thoughts each morning at the close of Wall Street, check out my website, switzer.com.au. That's your show for tonight. I'll see you next week.